The story of Ben Horowitz. From code to culture and building Andreessen Horowitz. Ben Horowitz was born on June 13, 1966, in London, England. His father, David Horowitz, was a prominent figure in American politics and culture. David had been a radical leftist in the 1960s, working as an editor for Ramparts magazine, a leading voice of the New Left. By the time Ben was growing up, his father had begun a dramatic ideological transformation that would eventually make him one of the most controversial conservative intellectuals in America. This political evolution created a household where ideas were constantly debated, challenged, and refined. Nothing was taken for granted. Every assumption could be questioned. This environment taught Ben to think independently and to be comfortable with intellectual combat. The Horowitz family moved to Berkeley, California when Ben was young. Berkeley in the 1970s and 80s was a cauldron of political and cultural ferment. The university town was still recovering from the free speech movement and anti-war protests that had defined the previous decade. Growing up in Berkeley meant growing up around constant debate, protest, and intellectual intensity. For Ben, this meant learning early that strongly held beliefs could be challenged, that yesterday's orthodoxy could become tomorrow's heresy, and that courage meant standing by your convictions even when everyone around you disagreed. David Horowitz's political journey was remarkable and controversial. He had been close to the Black Panthers and had hired Betty Van Patter, a bookkeeper, to work with them. When she was murdered in 1974, allegedly by Panther members, David began questioning everything he had believed. Over the next decade, he moved from radical left to conservative right, eventually becoming a prominent Reagan supporter and founding the Center for the Study of Popular Culture. This transformation was public, painful, and deeply personal. For young Ben, watching his father endure intense criticism from former allies, being called a traitor and sellout, taught profound lessons about conviction, courage, and the cost of independent thinking. Ben's relationship with his father was complex. David was brilliant, passionate, and difficult. He expected intellectual rigor and didn't suffer fools. Dinner table conversations were more like seminars or debates than casual family chat. Ben learned to defend his ideas, to think clearly under pressure, and to separate the strength of an argument from the passion with which it was delivered. This training in intellectual combat would serve him extraordinarily well in the high-stakes world of technology startups, where decisive thinking under pressure often meant the difference between survival and failure. Despite, or perhaps because of, his father's political prominence, Ben developed his own path. He was drawn to technology and computers at a time when personal computing was just beginning to explode. He attended the University of California, Los Angeles, where he studied computer science. The early 1980s were a transformative time for computing. The IBM PC had just been released. Apple was growing rapidly. Microsoft was beginning its rise. Software was becoming recognized as potentially more valuable than hardware. Ben absorbed all of this, spending countless hours programming, understanding not just how to write code but how software could become a business. After UCLA, Ben joined Lotus Development Corporation in 1990. Lotus was one of the most successful software companies of the era, famous for Lotus 1-2-3, the spreadsheet program that had helped make the IBM PC essential for business. Working at Lotus gave Ben his first real exposure to how software companies operated at scale. He saw how products were developed, marketed, and sold. He saw how engineering teams worked, how product decisions got made, and how sales and marketing translated technical capability into customer value. Most importantly, he saw how quickly things could change in technology. Lotus, which had seemed invincible in the mid-1980s, was already facing serious competition from Microsoft Excel by the time Ben arrived. The Lotus experience taught Ben something crucial. Technical excellence alone wasn't enough. Lotus had brilliant engineers and a great product, but Microsoft was winning through superior business strategy, aggressive marketing, and ruthless execution. The best product didn't always win. The company that executed better, that understood the market better, that built better partnerships and distribution channels, that product won. This lesson, that business execution mattered as much as technical innovation, would shape everything Ben did later. In 1995, Ben joined Netscape Communications. This was arguably the most important career move of his life. Netscape had been founded just a year earlier by Mark Andreessen and Jim Clark. Mark was a 22-year-old programmer who had created Mosaic, the first widely used web browser, while at the University of Illinois. Jim was a successful entrepreneur who had founded Silicon Graphics. Together, they were building Netscape Navigator, a commercial web browser that was making the internet accessible to millions of people for the first time. Joining Netscape in 1995 meant joining at the absolute center of the internet revolution. The World Wide Web had been invented by Tim Berners-Lee in 1989, but it was Netscape Navigator that made it usable for ordinary people. Before Navigator, the web was largely text-based and required technical knowledge to navigate. Navigator added graphics, made navigation intuitive, and turned the web from a curiosity into a platform that could change everything. Ben arrived just as Netscape was preparing for its initial public offering, which would become one of the most famous IPOs in history. The Netscape IPO on August 9, 1995, marked the beginning of the internet boom. The stock was priced at $28 per share but opened at $75 and closed at $58, giving the barely profitable company a market value of nearly $3 billion. This was unprecedented. Companies were supposed to be profitable before going public. They were supposed to have established business models and predictable revenue. Netscape had potential and momentum, but it was burning through cash and facing the imminent threat of Microsoft, which had announced it would give away Internet Explorer for free with Windows. Ben worked in product management at Netscape, helping to shape the evolution of Navigator and other products. This meant he was right in the middle of the browser wars, the epic battle between Netscape and Microsoft for control of the web browsing market. It was brutal. Microsoft had nearly unlimited resources and was willing to use its Windows monopoly to crush Netscape. They bundled Internet Explorer with Windows, gave it away for free, and used every advantage they had. Netscape fought back hard, trying to build a business around server software and enterprise products, but the writing was on the wall. The Netscape experience was transformative for Ben in multiple ways. First, he met Mark Andreessen. Mark was brilliant, visionary, and incredibly driven. He understood the potential of the internet better than almost anyone. He could see how it would transform not just technology but society, commerce, media, everything. Mark and Ben formed a partnership based on mutual respect and complementary skills. Mark was the visionary technologist. Ben was the operator who could execute. This partnership would eventually create one of the most successful venture capital firms in history. Second, Netscape taught Ben about competition at the highest stakes level. This wasn't academic. This wasn't a game. Microsoft was trying to destroy Netscape, and they had the resources and determination to do it. Ben saw what real competitive warfare looked like. He saw how companies fought for survival. He learned that you had to be willing to do whatever it took, to make hard decisions, to keep fighting even when the odds seemed impossible. The intensity of those years, the pressure of competing against Microsoft while trying to build a real business, forged something in Ben. He learned to operate under extreme stress, to make decisions with incomplete information, to keep a team motivated when things looked bleak. Third, he learned about the importance of company culture. Netscape had an incredibly strong culture in its early years. People believed they were changing the world. They worked insane hours because they wanted to, not because they had to. There was a sense of mission that transcended individual job descriptions. Ben saw how that culture drove extraordinary performance, and he also saw how difficult it was to maintain as the company grew and faced mounting competitive pressure. This would become one of his signature themes later, the idea that culture wasn't soft or secondary but absolutely central to a company's ability to execute and win. By 1998, it was clear that Netscape was losing the browser war. Microsoft's strategy of giving away Internet Explorer for free and bundling it with Windows had worked. Netscape's market share was declining. The company needed a new strategy. In November 1998, America Online announced it would acquire Netscape for $4.2 billion. The acquisition made strategic sense for AOL, which wanted Netscape's technology and engineering talent, but it was bittersweet for the people who had built Netscape. They had fought hard, but Microsoft had been too powerful. After the AOL acquisition, Ben could have stayed on and taken a comfortable role in the merged company. Instead, he decided to do something much riskier. In September 1999, he co-founded Loudcloud with Mark Andreessen, Tim Howes, and In-Sik Rhee. Loudcloud was a hosting and infrastructure services company designed to help other companies build and run their internet applications. The idea was simple. The late 1990s saw an explosion of internet companies, all of which needed complex technology infrastructure. Most didn't have the expertise or resources to build and manage their own data centers. Loudcloud would do it for them. The timing seemed perfect. The dot-com boom was at its peak. Companies were raising enormous amounts of venture capital and spending it rapidly to build internet services. They needed infrastructure fast, and they were willing to pay for it. Loudcloud raised $66 million in its first round of funding, an enormous sum that reflected both the ambition of the idea and the reputation of the founders. Ben became CEO, the first time he had run a company. He was 33 years old and about to get the education of a lifetime. Running Loudcloud was incredibly hard from day one. The company had to build massive infrastructure, data centers filled with servers, networking equipment, and software. They had to hire hundreds of people to manage this infrastructure. They had to sign up customers and deliver services that worked perfectly. All of this required enormous amounts of capital. Between September 1999 and March 2000, Loudcloud raised a total of $120 million from top venture capital firms. They were growing fast, signing up high-profile customers, and it seemed like nothing could stop them. Then the dot-com bubble burst. In March 2000, the Nasdaq peaked and began a brutal decline that would eventually wipe out trillions of dollars in market value. By April 2001, dozens of internet companies were failing every month. This was catastrophic for Loudcloud. Their customers were going bankrupt, which meant they couldn't pay their bills. Revenue was collapsing just as Loudcloud's costs remained high. The company had built infrastructure for growth that was no longer happening. They were burning through cash at an alarming rate. Ben faced a nightmare scenario. The company was running out of money. Customers were disappearing. The venture capital market had completely frozen. Nobody was funding companies anymore, especially not infrastructure companies serving dying dot-com startups. Loudcloud needed to raise more money to survive, but there was essentially no market for private investment. Ben had to make a decision that seemed crazy to almost everyone around him. In March 2001, he decided to take Loudcloud public. Taking a money-losing company public during the worst market crash in decades seemed insane. Investment bankers told Ben it couldn't be done. Advisors said he was making a mistake. But Ben saw it as the only option. If Loudcloud stayed private, they would run out of money and die. If they went public, they at least had a chance. The IPO was brutal. The company had hoped to price shares at $10 to $12. Instead, they priced at $6, the absolute minimum the underwriters would accept, and raised only $162 million, far less than they needed. The stock immediately began declining. Within months, it was trading at $2 per share. Loudcloud had a market value of less than $200 million despite having raised nearly $300 million total. Ben was CEO of a public company that many investors considered worthless, serving customers who were going bankrupt, in a market that had collapsed. Most people in his position would have given up. The situation seemed hopeless. The company was burning cash, revenue was declining, and the stock price suggested investors expected bankruptcy. But Ben didn't give up. Instead, he made a series of extraordinary decisions that would save the company and, more importantly, teach him lessons that would shape his entire approach to business and investing. First, he realized that Loudcloud's infrastructure services business, while important, wasn't going to generate enough margin or growth to survive. The company needed to transform. They had built an incredible software platform called Opsware to manage all of their infrastructure. That software was actually more valuable than the services business. In the summer of 2002, Ben made a shocking decision. He would sell Loudcloud's core infrastructure services business to EDS for $63.5 million and transform the company into a pure software company focused on Opsware. This meant firing most of the company's employees, abandoning the business model they had spent 3 years building, and betting everything on unproven software. The board was skeptical. Investors were furious. The stock price collapsed to under $1 per share. But Ben believed it was the only path to survival. The transformation was agonizing. Ben had to lay off hundreds of people, many of whom had joined Loudcloud because they believed in the mission and trusted him. He had to explain to investors why their money-losing infrastructure company was now a different money-losing software company. He had to keep the remaining team motivated when everything seemed to be falling apart. This period, from 2002 to 2004, was the darkest time in Ben's professional life. He later wrote about it extensively in his book, The Hard Thing About Hard Things, describing the psychological toll of leading a company through near-death experiences. But the Opsware transformation worked. Slowly, painfully, the software business began to grow. Companies needed tools to manage their increasingly complex IT infrastructure, and Opsware was genuinely better than the alternatives. By 2004, the company was growing revenue and approaching profitability. By 2005, they were profitable. The stock price recovered from under $1 to over $6. Ben had saved the company through sheer determination, brutal decision-making, and refusal to give up. In 2007, HP approached Opsware about an acquisition. After months of negotiation, HP agreed to buy Opsware for $1.6 billion, nearly $14 per share. This was an extraordinary outcome. A company that had been trading at 60 cents per share 5 years earlier was being acquired for $14. Investors who had stuck with the company made enormous returns. Employees got life-changing payouts. Ben had taken a company through hell and emerged victorious. More importantly, he had learned lessons that money couldn't buy. The Opsware experience taught Ben things that most people never learn because they give up before reaching that level of difficulty. He learned that the hard thing about hard things isn't that they're intellectually difficult, it's that they're emotionally devastating. Laying off people you care about. Delivering bad news to investors who trusted you. Making decisions with incomplete information where every option seems terrible. Working 100-hour weeks for years while your stock price says you're failing. This forges something in a person. Ben emerged from Opsware with a depth of understanding about company building that very few people possessed. He also developed a philosophy about company culture that would become central to his later work. During Opsware's darkest days, Ben realized that culture wasn't about perks or slogans. It wasn't about foosball tables or free lunch. Culture was about what you do when things are hard. Do people quit or do they fight harder? Do they blame each other or do they work together? Do they lose faith or do they find ways to win? The Opsware culture, forged in crisis, was incredibly strong. People stayed because they believed in the mission and in each other. Ben learned that great culture comes from shared struggle and shared victory, not from comfort. Another crucial lesson was about decision-making. Ben learned that most business decisions are made with incomplete information and uncertain outcomes. You can't wait for perfect clarity because it never comes. You have to develop judgment, the ability to make the best decision possible with the information you have, and then commit to making that decision work. He also learned that the worst thing a CEO can do is waffle or show weakness. Your team needs to believe that you know what you're doing even when you're terrified. This doesn't mean lying or false confidence. It means projecting calm determination even when things are falling apart. After the Opsware sale to HP in 2007, Ben was 41 years old and wealthy. He could have retired. He could have become an angel investor, casually funding startups and enjoying life. Instead, he and Mark Andreessen decided to start a venture capital firm. This decision surprised many people. Ben and Mark were operators, not investors. They had built companies, not funded them. Traditional venture capital was dominated by firms like Sequoia, Kleiner Perkins, and Benchmark, partnerships that had been investing for decades and had deep networks and proven track records. But Ben and Mark saw an opportunity. They believed that venture capital was changing and that their operational experience gave them a unique advantage. Traditional VCs were often financially sophisticated but operationally limited. Many had never run companies or dealt with the kind of existential crises that Ben had navigated at Opsware. Ben and Mark believed they could add more value to founders because they had been founders themselves. They knew what it felt like. They knew the hard questions and the hard decisions. They could provide not just money but genuine operational help. In 2009, they founded Andreessen Horowitz, often called A16Z, using the numeronym for the 16 letters between A and Z in Andreessen. They raised their first fund of $300 million, which was large for a first-time fund but reflected their reputation and the strength of their network. From the beginning, they wanted to build a different kind of venture capital firm. They didn't want to be passive check writers who showed up at board meetings. They wanted to be active partners who helped companies win. One of their key innovations was building a huge team of operational partners and specialists who could help portfolio companies with everything from recruiting to marketing to business development. Traditional VC firms were small, typically a handful of partners and a few associates. Andreessen Horowitz eventually grew to over 100 employees, more like a consulting firm than a traditional VC. Critics said this wouldn't scale and that the overhead would kill returns. Ben and Mark disagreed. They believed that helping companies succeed was worth the investment. The firm's approach was also shaped by Ben's Opsware experience. He knew that most startups would face existential crises. He knew that CEOs would need help navigating those crises. So Andreessen Horowitz positioned itself as the firm that understood hard things, that could help when things went wrong, not just when things were easy. This resonated with founders, especially technical founders who worried about the business side of building companies. The message was clear. We've been where you are. We know it's hard. We can help. The firm's investment philosophy was shaped by several core beliefs. First, software was eating the world. This was Mark's phrase, and it became the firm's thesis. They believed that every industry would eventually be transformed by software, and that the biggest opportunities were in applying technology to industries that hadn't yet been disrupted. This led them to invest not just in traditional tech companies but in startups attacking healthcare, finance, education, transportation, and other massive markets. Second, they believed in backing exceptional founders, even when the idea seemed crazy or the market seemed impossible. This came from Ben's experience. Loudcloud and Opsware had both seemed like terrible ideas at various points, but they succeeded because of determination, adaptability, and refusal to quit. Ben and Mark wanted to back founders with those qualities, even if the initial pitch wasn't perfect. They were looking for people who could navigate uncertainty and build great companies through sheer force of will. Third, they believed that the best founders were often technical founders who deeply understood their domain. This was contrarian. Many VCs preferred MBA types who could articulate clear business plans. Ben and Mark, both technical people themselves, believed that deep technical insight was often more valuable than business polish. Technical founders could see opportunities that others missed, could build products that were genuinely better, and could earn the respect of engineering teams in ways that business types often couldn't. Fourth, they believed in the importance of company culture. Ben's Opsware experience had taught him that culture was a competitive advantage. Companies with strong cultures could attract better people, execute faster, and survive crises that would destroy weaker organizations. Andreessen Horowitz invested heavily in helping portfolio companies build great cultures, thinking through values, hiring processes, communication systems, and all the soft stuff that many VCs ignored. The firm's early investments validated their approach. They invested in Facebook, Twitter, Groupon, Zynga, Foursquare, and many other high-profile companies. Some were huge successes. Others struggled or failed. But the overall track record was strong, and the firm's reputation grew rapidly. By 2010, just a year after launching, Andreessen Horowitz was already considered one of the top venture firms in Silicon Valley. By 2012, they had raised a second fund of $2.7 billion, an enormous increase that reflected their success. One of the firm's most important early investments was in Facebook. Andreessen Horowitz invested in Facebook's secondary offering in 2010, buying shares from existing shareholders at a valuation that seemed high at the time but proved prescient. Facebook went public in 2012 and became one of the most successful technology companies in history. The Facebook investment returned billions of dollars to Andreessen Horowitz's funds and validated their thesis that social networks and communication platforms were profoundly important. Ben also became known for his writing and thinking about company building. In 2010, he started a blog where he wrote about leadership, decision-making, culture, and the challenges of building companies. His posts were raw, honest, and deeply personal. He wrote about firing executives, dealing with depression, making life or death decisions, and all the things that most business writers avoided. The blog became incredibly popular because it was real. Ben wasn't pretending that entrepreneurship was easy or glamorous. He was telling the truth about how hard it was, and that honesty resonated with thousands of founders who were struggling with similar challenges. In 2014, Ben published The Hard Thing About Hard Things, a book based on his blog posts and experience at Loudcloud and Opsware. The book became a bestseller and a Bible for entrepreneurs. It was different from most business books because it didn't promise easy answers or simple formulas. Instead, it acknowledged that building companies is brutally hard, that there are no shortcuts, and that the only way through is to keep fighting. The book's honesty and practical wisdom made it essential reading for anyone in the startup world. One of the book's most famous concepts was the idea of wartime versus peacetime CEOs. Ben argued that most leadership advice was designed for peacetime, when companies are executing known strategies in stable markets. But many startups, especially in their early years, are in wartime, fighting for survival against competitors, market changes, or internal crises. Wartime requires different leadership. It requires decisiveness, speed, and sometimes ruthlessness. Many founders struggled because they tried to be peacetime CEOs when their companies were actually at war. Another key insight was about the importance of giving hard feedback and making hard decisions quickly. Ben wrote about how he had sometimes waited too long to fire executives who weren't working out, how he had sometimes avoided difficult conversations, and how this always made things worse. He argued that the best thing a leader could do was be honest and direct, even when it was painful. This philosophy shaped how Andreessen Horowitz worked with portfolio companies. They would tell founders hard truths rather than soft reassurances. As Andreessen Horowitz grew, it became known not just for its investments but for its cultural influence in Silicon Valley. The firm took strong positions on issues that other VCs avoided. Ben and Mark were vocal about the importance of founder control, arguing that founders should maintain voting control of their companies even after raising venture capital. This was controversial because traditional VCs often wanted board control and the ability to replace founders who weren't performing. But Ben and Mark believed that great companies were built by founders with long-term vision, not by professional managers optimizing for quarterly results. They were also vocal about the importance of defending technology and innovation against regulatory and media criticism. As big tech companies like Facebook, Google, and others came under increasing scrutiny in the 2010s for issues around privacy, content moderation, and market power, many in Silicon Valley became defensive or apologetic. Ben and Mark took a different approach. They argued forcefully that technology had made the world dramatically better, that innovation was essential for progress, and that many criticisms of tech companies were misguided or motivated by politics rather than genuine concern. This stance made them controversial. Critics accused them of being tech triumphalists who ignored real problems. Supporters saw them as principled defenders of innovation against forces that would stifle progress. Ben's political background, growing up with a father who had moved from far left to far right, made him comfortable with controversy and disagreement. He believed that strong positions were better than mushy centrism, that clarity was more valuable than consensus. By the mid-2010s, Andreessen Horowitz was managing multiple funds totaling billions of dollars and had become one of the most powerful institutions in Silicon Valley. The firm had invested in many of the most important technology companies of the era, including Airbnb, GitHub, Instacart, Lyft, Pinterest, Slack, and many others. Some investments were spectacular successes. Others were disappointments. But overall, the track record was strong, and the firm's reputation for helping companies succeed was well established. One area where the firm took a contrarian position was in cryptocurrency and blockchain technology. Starting around 2013 and accelerating in 2017 and 2018, Andreessen Horowitz made major investments in crypto projects and companies. They believed that blockchain technology would be as transformative as the internet itself, enabling new forms of money, contracts, organizations, and coordination. This was highly controversial. Many serious investors viewed crypto as a bubble or scam. But Ben and Mark saw something different. They saw parallels to the early internet. In the 1990s, most people thought the internet was a toy or fad. Serious business people dismissed it. But a few visionaries saw that it would change everything. Ben and Mark believed crypto was similar. It seemed speculative and weird in 2018, but it might be the foundation for the next generation of computing and finance. They launched dedicated crypto funds, invested billions of dollars, and became the most prominent institutional backers of the crypto space. This commitment to crypto reflected a broader aspect of Ben's approach to investing and company building. He believed that the biggest opportunities came from backing things that seemed crazy to most people. If something seemed obviously smart and everyone agreed it would work, it probably wasn't a great opportunity because competition would be intense and returns would be limited. But if something seemed crazy, if most serious people dismissed it, if you had to defend it constantly, that might be where the real opportunity was. This required conviction and willingness to be wrong publicly. Throughout the 2010s, Ben also became known for his thinking about company culture and management. He wrote extensively about hiring, firing, organizational design, and the psychological challenges of leadership. One of his key insights was that most management advice was useless because it assumed stability and predictability. But startups were inherently unstable and unpredictable. So founders needed different frameworks and different approaches. They needed to be comfortable with chaos, ambiguity, and constant change. He also wrote about the importance of diversity and inclusion, though in a different way than most people approached these topics. Ben argued that diversity wasn't primarily about fairness or representation, though those were important. It was about effectiveness. Diverse teams made better decisions because they saw problems from multiple angles. Homogeneous teams suffered from groupthink and blind spots. So building diverse teams wasn't about political correctness. It was about building better companies. This framing resonated with some people and frustrated others, but it reflected Ben's pragmatic approach to everything. By 2020, Andreessen Horowitz was managing over $16 billion across multiple funds, including traditional venture funds, growth equity funds, and crypto funds. The firm had invested in many of the most important technology companies of the past decade and had helped shape the direction of multiple industries. Ben was 54 years old and had achieved extraordinary success as both an operator and investor. But he continued to be deeply engaged, writing, thinking, and helping founders navigate the challenges of building companies. The COVID-19 pandemic in 2020 created new challenges and opportunities. As the world shut down, many businesses struggled, but technology companies often thrived. Remote work accelerated the adoption of software tools. E-commerce exploded as physical retail closed. Telehealth and online education suddenly became essential. Andreessen Horowitz's thesis that software was eating the world seemed more prescient than ever. The firm continued to invest aggressively, backing companies that were enabling the shift to digital everything. One of Ben's enduring contributions has been his willingness to share what he learned. Unlike many successful investors who guard their insights jealously, Ben has been remarkably open about his experiences, failures, and lessons. Through his blog, his book, his podcast appearances, and his speeches, he has taught thousands of entrepreneurs about the realities of building companies. He has demystified venture capital, explained decision-making frameworks, and provided practical advice that actually helps people. This generosity has built enormous goodwill and made him one of the most respected figures in technology. Looking at Ben's journey from Netscape employee to Loudcloud founder to Andreessen Horowitz co-founder reveals several key patterns that explain his success. First, he was willing to do hard things. Most people, when faced with the challenges Ben faced at Loudcloud and Opsware, would have quit. The easier path would have been to shut down the company, return what money was left to investors, and move on. Ben refused. He fought through years of crisis because he believed in what they were building and because he refused to give up on the people who had trusted him. Second, he learned from every experience. The Netscape experience taught him about competition, culture, and the importance of execution. The Loudcloud experience taught him about crisis management, decision-making under pressure, and the psychological toll of leadership. He didn't just survive these experiences. He extracted lessons from them and used those lessons to become a better operator and investor. His willingness to be brutally honest about his mistakes and failures made him smarter and more effective. Third, he built deep relationships based on respect and complementary strengths. His partnership with Mark Andreessen was the foundation of everything he built after Netscape. Mark and Ben weren't the same person. They had different strengths, different styles, different ways of seeing the world. But they respected each other deeply and trusted each other completely. This partnership worked because they made each other better. Mark's vision combined with Ben's execution created something neither could have built alone. Fourth, he developed strong frameworks and principles that guided his decision-making. The ideas in The Hard Thing about hard things, about wartime leadership, about giving hard feedback, about making decisions with incomplete information, weren't just interesting concepts. They were battle-tested frameworks that he had used to navigate real crises. He codified what he learned so that others could benefit from his experience. This intellectual rigor, the ability to extract general principles from specific experiences, made him an exceptional thinker and teacher. Fifth, he was willing to be contrarian. Whether it was taking Loudcloud public during a market crash, transforming the company into Opsware, building an unconventional VC firm with a huge operational team, or investing billions in crypto when most serious investors were skeptical, Ben consistently made bets that seemed crazy to consensus opinion. This wasn't contrarianism for its own sake. He had reasons for each decision. But he was willing to endure criticism and doubt because he believed in his analysis. This courage to be different was essential to achieving exceptional results. The secret sources of Ben's investing success at Andreessen Horowitz come from these experiences and qualities. First, he had genuine operational expertise that few VCs possessed. He had lived through the things his portfolio companies were experiencing. He knew what it felt like to be running out of money, to face existential competition, to have to fire people you cared about, to make decisions where every option seemed terrible. This gave him credibility with founders and allowed him to provide advice that was actually useful rather than theoretical. Second, he understood that culture and organization were as important as strategy and product. Many investors focused primarily on market size, product differentiation, and competitive positioning. Ben cared about those things, but he also cared deeply about whether the company had the right culture to execute, whether the team worked well together, whether the founder had the temperament to lead through crisis. He could see organizational dysfunction that other investors missed, and he could help fix it. Third, he had pattern recognition from building companies in multiple technology waves. He had seen the browser wars of the 90s. He had lived through the dot-com boom and bust. He had built an infrastructure company and a software company. He had seen multiple market cycles and technological shifts. This gave him perspective that younger investors lacked. He could see which patterns were new and which were repeating. He knew which concerns were overblown and which were serious. Fourth, he and Mark built an institutional platform at Andreessen Horowitz that could provide real value to companies beyond capital. The operational partners who helped with recruiting, marketing, business development, and other functions weren't window dressing. They were genuine experts who could move the needle for portfolio companies. This platform was expensive to build and maintain, but it created a sustainable competitive advantage. Companies wanted to work with Andreessen Horowitz not just for the money but for the help. Fifth, he was willing to make concentrated bets on companies and sectors he believed in. While some VCs spread their capital across many small investments, hoping for a few hits, Ben and Mark were willing to make large investments in companies they believed would be transformational. This required conviction and courage, but it also generated exceptional returns when they were right. The Facebook, Airbnb, and crypto investments were large enough to move the needle for their funds. Ben's legacy extends beyond the financial returns of Andreessen Horowitz. He has changed how people think about company building and leadership. The Hard Thing About Hard Things and his other writings have influenced thousands of entrepreneurs. His willingness to talk honestly about failure, depression, doubt, and fear has made it more acceptable for other leaders to acknowledge these struggles. His frameworks for decision-making and culture building have been adopted by companies around the world. He has also influenced how venture capital works. The Andreessen Horowitz model of building a large operational team to help portfolio companies has been copied by other firms. The emphasis on helping with hard things rather than just providing capital has become more common. The focus on backing technical founders and betting on contrarian ideas has influenced how many investors think about sourcing and evaluating opportunities. While traditional venture capital still exists, Ben and Mark proved that there was another way to do it. Looking at Ben's journey today, several lessons emerge for anyone building companies or investing in them. First, survival is a skill. The ability to keep going when things seem hopeless, to find ways to win when every option seems bad, to maintain morale when everything is falling apart, these abilities can be developed through experience and deliberate practice. Ben survived Loudcloud and Opsware not because he was lucky but because he refused to quit and because he made brutal decisions when necessary. Second, operational experience matters enormously in investing. Financial analysis and market knowledge are important, but understanding how companies actually work, how decisions get made, how teams function, how crises unfold, this knowledge is invaluable. Ben's operational background made him a better investor because he could see things other investors missed and because he could add value in ways other investors couldn't. Third, great partnerships are built on complementary strengths and mutual respect. Ben and Mark's partnership worked because they were different but aligned. They had different skills, different perspectives, different ways of working, but they respected each other deeply and trusted each other completely. They made each other better. This kind of partnership is rare and precious, and it requires constant work to maintain. But when it works, it can create extraordinary outcomes. Fourth, frameworks and principles matter. Ben's success wasn't just about working hard or being smart. It was about having clear frameworks for making decisions, for building culture, for managing people, for navigating crises. These frameworks were battle-tested and refined through experience. They gave him and his team a systematic way to approach problems rather than just relying on intuition or luck. The ability to extract general principles from specific experiences is a crucial skill for anyone building or investing in companies. Fifth, being contrarian requires courage and conviction. It's easy to follow consensus. It's comfortable to do what everyone else is doing. But exceptional returns come from being right when others are wrong. This requires the courage to endure criticism, the conviction to stick with your beliefs when everyone doubts you, and the intellectual honesty to change your mind when you're wrong. Ben demonstrated this courage repeatedly, from taking Loudcloud public in a terrible market to investing billions in crypto when most thought it was a bubble. The story of Ben Horowitz is ultimately a story about resilience, learning, and the power of experience. He wasn't born into wealth or privilege. He didn't have obvious advantages. What he had was curiosity, determination, and a willingness to do hard things. He learned from every experience, even the painful ones. He built relationships based on respect and shared struggle. He developed frameworks and principles that guided his decision-making. And he had the courage to be contrarian when he believed he was right. From the chaos of his father's political transformation to the intellectual combat of Barclay dinner tables, from the browser wars at Netscape to the near-death experiences of Loudcloud and Opsware, from the creation of Andreessen Horowitz to its emergence as one of the most influential venture capital firms in the world, Ben's journey shows what's possible when someone refuses to quit, learns from every experience, and builds on a foundation of hard-won operational knowledge. Today, as software continues to eat the world, as new technologies like artificial intelligence and blockchain promise to transform industries, as new generations of founders face the eternal challenges of building companies and leading teams through uncertainty, Ben's lessons and frameworks remain profoundly relevant. The hard thing about hard things hasn't changed. Building companies is still brutally difficult. Leadership still requires making decisions with incomplete information. Culture still matters enormously. And the ability to survive and thrive through crisis is still the most valuable skill an entrepreneur or investor can have. Ben Horowitz's story is a testament to the power of perseverance, the value of operational experience, and the possibility of success even when the odds seem impossible. His legacy will be measured not just in the billions of dollars his investments have generated, but in the thousands of entrepreneurs who have benefited from his wisdom, his honesty, and his refusal to pretend that building great companies is anything other than incredibly hard.